Hello, everyone. So apologies for the delay. We were just allowing a few minutes because some people left the building to have lunch outside, and when they were coming back, they had to enter in the line to enter in the building, so that's why we have some people a bit late. But let's get started. Two quick notes before we move into the plenary session. One is just to remind you, as I said before, please remember to complete the evaluations forms that you found when you came here today. They really help us to improve the program. When you complete it, you can leave it on your desk or you can handle to any one of the event staff. The second note is that those who attended the breakout session yesterday on debt transparency, you've received a survey that is being conducted by the IIF with support from the World Bank, support from the G20. So for those who received it and completed also, please don't forget to handle it to us. Again, you can also leave on your desk or handle to one of the event staff. Those who haven't participated in this breakout session, which was on debt transparency, and those who want to look at the survey and maybe participate at the survey, we're going to have these questionnaires just outside the room, besides the globe. You're going to find questionnaires if you want to go ahead and participate. So having said that, let's move into our final plenary session of the forum. Which is about a different conceptual approach to sovereign asset and liability management. The moderator for this session is Josh Kangos, who is the head of the government debt and risk management at the World Bank Treasury. So let me invite Josh and the panelists to take their seats now.
Good afternoon, everyone. As Rodrigo mentioned, this is the last session of the day and the last plenary. And even if the name of the title of the event, the session is a different approach, we all know that asset and liability management. We all familiar with that, and this has been discussed maybe over the last 2 decades. I remember also in Graham's book. There are a lot of references, and there are some chapters, and there are some very useful information in that, how to implement asset and liability management in sovereigns. And so today we have a very distinct panel, and we have Richard Hughes, Rob Nicol, and Fatosh Koch. And let me first introduce the panel members, our panelists, and then I'll make a short introduction. Then I'll pass floor to the panelists. So I will just start with Richard. He is the Director of Fiscal Policy at UK Treasury, HM Treasury, since 2016. But prior to that, he was working at the IMF for 8 years, and he was the head of division of the Fiscal Affairs Department in the IMF, Public Financial Management Division. Richard has a wide variety of experience, starting from spending reviews and domestic international roles in different capacities. So he also advised French government when he was working with the HM Treasury before joining to the IMF. So next to Richard, we have Rob. He is the Chief Executive Officer at the Australian Office of Financial Management. Actually, I remember when I visited Australian like 20 years ago, the name of the department was Australian Debt Management Office. So then it changed to the Office of Financial Management. So maybe it has a story, and maybe Rob can mention about it as a part of this asset and liability management discussions. So before joining the Australian Office and Financial Management, Rob was the Deputy Secretary of the Tasmanian Treasury, and he has also extensive commercial and regulatory experience. And he also worked as a research fellow at the University of Tasmania. So we have also Fatosh Koch today joining us. She's the head of Public Debt Management Unit at the OECD. Also prior to that, she was working for Turkish government at Turkish Treasury, and she was one of the core members of the debt management reform team in Turkey. And I'm really happy that she was one of the person of my team when I was also in Turkey. So I was lucky that she was with us at that time. Let me start with a short introduction before our panelists make their presentations. So you see on the screen, it is the name or it is the title of our paper that we are going to publish soon, hopefully in 5 days or late next week. And this is about a survey that we have conducted in coordination with the OECD and the IMF. And we sent the survey to around 50 countries, and 25 of them responded just about the asset and liability management practices in that countries. Again, to understand the capacity in sovereigns and their approach, how to manage their assets and liabilities. But before going that, as you may remember from Professor Rogov's presentation, first, of course, we need to have a public sector balance sheet. This is from the IMF's recent fiscal monitor report. And again, when we look at the public sector balance sheet, it is not only the, of course, debt, it is not only the liabilities. We have also financial and non-financial assets. So in that sense, we are not the only ones, or even, the public debt is the biggest portfolio in many countries. We are not the only ones as debt managers who are in charge of managing the public sector balance sheet. So there are other portfolios and other assets and liabilities that we need to take care of. But this is a simplified version of the balance sheet. Again, this is not only the figures, this is not only the balance sheet itself. There are some other external factors. So each one of the items in the balance sheet, both on the asset side and the liability side, they are exposed to different external shocks. So this can be a variety of risks. This can be interest rate risk, commodity risk, currency risk, demand risk, inflation risk. There are a lot of risks around the balance sheet. So also, in many balance sheets, we don't have the contingent assets and liabilities when we look at the public sector balance sheet. But in this conceptual balance sheet, of course, we need to add contingent liabilities and, of course, the contingent assets. So we had some discussions during different sessions referring to different type of risks, including the FX risk, including the contingent liabilities, liability management operations over the last 1.5 days. So all that discussions were just giving us an idea to have a better look to the balance sheet overall. So number one, of course, we should have a balance sheet. Number two, there are some risks that we need to care about. And then, of course, we move to another question or another discussion. So which assets and liabilities we need to cover in our balance sheet, and also how we need to coordinate. So there are a lot of questions around this discussion. And also there are some practical discussions, what should be the accounting rules, what are the roles and responsibilities, we can have additional questions. So that's why, just having these questions in mind, we did this survey, and we sent it to, as I mentioned, around 50 countries. So we asked them what is the rationale behind this, producing this balance sheet, because almost all of the countries responded to our questionnaire. They have a sovereign balance sheet or public sector balance sheet, however you call. And again, 24 out of 28 respondents mentioned that they produce the balance sheets just to monitor or oversee the financial position of the government. As you see, only 6 of them, like 25% of the respondents, mentioned that they use balance sheets just to determine the mismatches between assets and liabilities. So then another question was about the accounting system, which accounting system they use to produce the balance sheet. And as you see here, 18 countries out of 28 either use fully accrual accounting system or semi-accrual. And so this also gives us a clear idea that accrual-based accounting system is a strong or is a very useful tool for governments to produce some meaningful balance sheets. Also, this is another information produced by the IMF. It is based on a recent technical IMF note. And this clearly shows that there are many countries, actually, around 40, 50 countries, employing the accrual-based accounting. But on the other side, there are more than 100 countries. They still use cash-based accounting system. Again, this clearly tells us that there's a significant room to implement asset and liability management approach in the world across countries. So the coverage of the balance sheet also gives us some clear ideas. And in most of our respondents mentioned that almost all of them, cash, financial receivables, state-owned enterprises, equities, on lending, those are all in on the asset side of the balance sheet. Some of them, 7 countries, mentioned that international reserves are also part of the balance sheet. And only 1 country mentioned that the present value of future income tax revenues take place in the balance sheet. So in terms of liabilities, of course, sovereign debt, it is almost all countries. They mentioned that sovereign debt is in their balance sheet. But it is interesting to see that some others, 8 countries, highlighted that currency in circulation take place in the liability side. And deposits of commercial banks, so guarantees, legal claims, pension liabilities, they are also considered in the liability side of the balance sheet. So of course, there are some challenges highlighted by the respondents. The most significant one is of course, valuation of the assets, and data availability is another important challenge which our respondent countries mentioned. And mandate, which means different objectives, and the authority given by the government to these different entities, it is not clear, and it doesn't cover the asset and liability management approach. So those are the main challenges, but I believe we will come back to these challenges, and also we will come back to the responses to these challenges during the panel discussions. So I would like to now give floor to Richard, just to share UK experience with us.
Okay. Thank you very much, Coşkun. I wanted to take a few minutes just to take you through the work that we're doing in the UK to try and manage the public sector balance sheet. Can I just borrow your click? And I'll look to cover. We've been collecting and publishing data on public sector assets and liabilities for over a decade in the UK. And so I thought I might start out just by describing the evolution of our balance sheet over the recent past, and then go on to talk about some of the various steps that we've been taking to try and more proactively manage the assets and also the non-debt liabilities on that balance sheet, and covering off the issues that you see here. I mean, just to start off with the evolution of the UK's public sector balance sheet, you can see from this chart here, which shows assets and liabilities, and then the black line is our net worth, that up until the financial crisis, the UK had a relatively small and fairly boring balance sheet. We had about 90% of GDP in mostly fixed assets, kind of land and buildings. And then on the liabilities side, we had just under 40% of GDP in debt, and then about 70% of GDP in other liabilities, mainly unfunded public service pension liabilities. And our net worth was sort of slightly negative at minus 20% of GDP. But then with the advent of the financial crisis in 2008, you saw in the UK, as you did in a lot of other advanced economies, an explosion in both sides of the balance sheet, as we acquired almost 200% of GDP in financial sector assets and matching liabilities from troubled private sector banks. And we also saw our debt to GDP ratio double to over 40% of GDP, both to finance those purchases, but also to finance the 10% of GDP budget deficit, which opened up in the aftermath of the crisis. And you can see that since the crisis, over time, after a decade, the government has steadily unwound its financial sector interventions, and that's reduced the size of its balance sheet by almost half. Those kind of dark red and dark blue blocks are the government unwinding its holdings of financial sector assets. But you've also seen a steady decline in net worth over that period, and that's partly a result of the persistent operating deficits that the government has run over this period, and also partly because of the post-crisis fall in the discount rate, which has increased the present value of our future pension obligations. And just to say a bit more about returning financial sector assets to the private sector, as I said, the single biggest contribution to the unwinding of our balance sheets over the last decade has been the fact that we have been returning financial sector assets acquired during the crisis back to the private sector. And you can see from this chart that the bulk of the government's initial cash outlay has been recouped either through principal repayments on the loans offered to these institutions or through dividends and fees received in the meantime. The UK government still owns about £29 billion worth of assets, mostly in the form of shares in the Royal Bank of Scotland, which once they're finally sold would leave the UK with a small net profit of about £11 billion on the overall set of interventions the government did in the wake of the crisis. So we're not sort of out of the money, but I wouldn't say it was a fantastically profitable enterprise to bail out the UK's financial sector, and it turned out to be rather less profitable than it was in the United States. One bank which remains on the public sector balance sheet in the UK is obviously the Bank of England. We don't have any plans to privatise it anytime soon. But the Bank of England, as Graham talked about this morning, has seen its own balance sheet explode since the crisis, primarily as the result of quantitative easing operations. And you can see that on the left-hand side, both the asset and liability side of the bank's balance sheet increasing considerably. As they bought government debt and other assets on the financial markets, and they issued bank deposits on the liability side of its balance sheet to finance them. The expansion in both sides of the bank's balance sheet has actually added to the risks to which the bank is exposed. And one of the things which concerned us as the Treasury was whether or not the bank had adequate risk-adjusted capital to actually deal with the risks that it was now bearing. And so one of the big judgments we've had to make about the management of both the Treasury and Bank of England's joint balance sheet is whether the bank, as a bank, is adequately capitalized to manage these risks. And as some of you may have seen, earlier on this year, the Treasury announced that it was providing the Bank of England with a £1.2 billion capital injection to bring its capital base up to something which we think is more in line with the risks that its expanded balance sheet now faces. It was also accompanied with a new deal that we did with the Bank of England around a new capital and income framework, which you can see on the right-hand side of that chart, which shows that it sets a target of keeping the bank's capital at around £3.5 billion. where their capital is above that level, they share their profits and dividends with the Treasury, but where their capital falls below that level, they retain all of their income and profits to bring their capital back up to that level. Were their capital to ever fall below 0.5 billion pounds, the Treasury has an agreement to automatically recapitalise the Bank of England, which formalises an informal commitment that we've had with them for some time, which has existed at least since they were nationalised in 1946. So one part of the government's more proactive approach to the management of the public sector balance sheet as a whole is to make sure that the Bank of England as a central bank is adequately capitalised to fund the duties that it has. But having sold most of the financial assets that we acquired during the financial crisis, last year we launched something which we call the balance sheet review, which is a wider review of the government's asset and liability holdings. The UK has about a decade of experience in conducting what we call comprehensive expenditure reviews as part of our budget process, where we do a detailed assessment of the value for money that we get from government spending, but we've never really applied that same discipline and the same rigors to our stocks of assets and liabilities, despite them being many multiples of annual government expenditure. And so the aim of this balance sheet review is really to take the wealth of balance sheet information that we now have, which is included in something called our whole of government accounts, and to identify opportunities to dispose of assets that no longer serve a public purpose, to improve the return and the utilization of assets that we still regard as core to delivery of public services, and to reduce the costs and risks associated with our liabilities. And I can take you through a few of the issues that we've come across in the course of doing this kind of comprehensive root and branch review of the public sector balance sheet. I think one thing that the review has already uncovered is the relatively untapped potential associated with the government's over £150 billion worth of intellectual property and other intangible assets, on the basis of some work that we've done, as well as some very good work done by the OECD. I think the UK has got about 8% of GDP in intellectual property and other intangible assets. We're about the 5th largest holder of these assets in the world in terms of governments. And these intangible assets include things like life-saving treatments developed in the National Health Service, new materials developed in our defence laboratories, traffic data held by the Department for Transport, our land registry, our postcode registry. And these assets have the potential to support the kind of high-growth, disruptive innovations that are driving the new global economy. And so what we're going to be doing on Monday is publishing a report alongside our budget, which is going to be looking into how can we as a government get a better financial, economic and social return from these kind of investments by getting smarter about the way we identify, protect and commercialize this sort of intellectual property, which is clearly proving very profitable for private sector companies that do similar kinds of innovations and hold similar kinds of intangible assets and forms of intellectual property. Another strand of the review, and something which we touched on at one of the breakout sessions before lunch, is the work that we're trying to do to manage the risks around the government's balance sheet, and in particular the risks that come from the government's growing stock of contingent liabilities. You can see from this chart that over the sort of last decade, what you've seen is there has been a fall-off in what we call remote contingent liabilities. That's the grey stuff here. And these are guarantees that the government offered in relation to the financial crisis to sort of high risk but low probability events of financial sector institutions going bankrupt. Those guarantees have rolled off as they've expired. But one of the interesting things that you've seen over the recent past, and in particular over the last 4 years, has been an increase in guarantees to areas like housing, infrastructure, trade, and they're all in the sort of red and pink stuff, which, while they are lower in volume, they are actually much more likely to crystallize. And so this sort of uptick in these non-financial sector but policy-driven guarantees has been something which has been of some concern to the Treasury. And so one thing that we have done last year is introduced a new control regime around the issuance of contingent liabilities, very much modelled on the frameworks developed in Sweden and in the Philippines long before we started doing this. But the aim was really to require ministries and departments that want to enter into these kind of contingent arrangements to explain the rationale for incurring contingent liabilities, estimate the potential exposure that they're undertaking, analyze the associated risks and returns, discuss the measures they're taking to mitigate and manage those risks, risks, and also demonstrates to the Treasury that were the residual exposure to be realized, they could afford it within their budgets. And this new approvals regime has enabled the Treasury to build up a database of contingent liabilities and their potential triggers, which we can use to analyze the government's exposure to different risk factors and the extent to which they are correlated with other risk factors that matter for the public finances. So that gives you, and I think I'm out of time, a quick overview of some of the work we've been doing to better understand the balance sheet in the UK, and also to try and get a better handle on some of the most important assets and liabilities that we have on it.
Okay, thank you very much. Indeed, you're supposed to do it in 15 minutes, but you did it 10 minutes maybe because of the confusion that the clerk was set on 10 minutes. Anyway, you have 15 minutes, Rob, and also Potter, so we owed you. And regarding your presentation, I just noticed that in the first slide that you showed us, the size of the public sector balance sheet just became, huge significantly compared to 2007 and 9, starting from 2008. Then maybe with the help of the returning of the financial assets to the private sector, we see a decline both in the asset and liability side. But on the other side, when we look at the Bank of England's balance sheet, it is really expanding after, again, starting from 2008. Is there any connection between these two charts or tables?
I suppose there's a contrast, which is that the government sort of got into, engaged in its financial sector interventions, bought a lot of equities, acquired banks, but as soon as the situation stabilized, has tried to withdraw from financial markets and put these assets back in the private sector under private management. The Bank of England sort of gone the other way, which is that they bought a lot of government debt as part of their QE operations. They've been now holding on to that debt in order to keep monetary policy relatively loose. And then in the wake of the Brexit referendum, as part of their concerns about further weakening in the economy, they've actually acquired a further round of assets in the wake of the referendum as a way of trying to support demand and keep financing conditions accommodative. And because they are already a very large holder of UK sovereign debt, they've actually looked at buying other classes of assets. So and that includes buying commercial loans, buying mortgages, and buying corporate bonds. Partly as a way of trying to get a better bang for their QE buck, because you've got bigger spread differentials on the cost, and hopefully a bigger impact, a bigger macroeconomic impact from that. And the Bank of England are holding on to most of those assets for the moment. Some of them get unwound in the next few years. But a question for the Bank of England, as well as a lot of other central banks out there at the moment, is what do they do with these large portfolios of government debt holdings, and what are their longer-term plans for unwinding them, if ever?
Okay, thank you. So now we are moving to Rob, and we know that Australia has been using this balance sheet approach for maybe 2 decades, or maybe more than 2 decades. So I'm sure that there are some interesting lessons that we can learn from Australia. Rob, please.
Sure. Thanks, Koskin. I think I came out of the breakout session upstairs on contingent liabilities, and I must say I felt somewhat cowed by the Swedes' approach to how they value contingent liabilities, and was quite in awe in the detail and structure and formality in which they approach that. And then I guess it just reminded me of the fact that we in Treasury hold a pretty high benchmark to how we would like to see Australia approach its fiscal responsibility. And we had I was feeling like we were a bit on the back foot until we had a rehearsal after lunch of this panel session, and both Koskin and Fatos were emphatic in trying to remind me that Australia actually has implemented some good things over time. I think one of the key messages that I wanted to leave with you, though, and I'll say this at the outset, is that the Australian government doesn't have, in some respects, a highly formalised structure in the way it approaches assessing and looking at risks on the balance sheet and the health of the balance sheet over time. But there's a lot of informal arrangements that work quite well, and I think the more important thing is that we do have a very good understanding of the shape and nature of the balance sheet and the risks that are on it, and there seems to be good processes in place to manage how risks get introduced to the balance sheet. And I think the other thing that I would mention is that successive Australian governments have been quite conscious of the need for the government, for the public sector in Australia to have a strong balance sheet. And I think a timely reminder of the benefits of that were the financial crisis, when Australia went into the financial crisis with, just to take one indicator, gross sovereign debt to GDP of 5%. It's still just under 30 at around 28. But that gave Australia a pretty lot of flexibility in terms of how it responded to the financial crisis, and the fiscal stimulus that was introduced at the time was done with the confidence that there was plenty of capacity on the balance sheet for the government to respond to the crisis. So what I thought I'd do is I would just take you through 4 points, and I would introduce a few examples in places rather than throw lots of charts up and tables. But first, just to look at what asset liability management might be, sort of from a bigger perspective. What we would say some of the useful features of balance sheet management are a sort of a focus on balance sheet management and derives. Some of the challenges that derive from trying to adopt this, and then run through some examples about to what extent we use it in Australia. Now, in many respects, if you look at the private sector, and I think banks are probably the best example, they would use asset liability management as an optimising tool of some sort. I've been around government for a very long time, and I've never seen any government optimise anything except their prospects of getting re-elected. So that's not something that we would necessarily approach asset liability management from, but it is a very useful framework, or it does provide a very useful set of guidelines. And if you think about it, government is very, very different from the private sector. And that's because its objective function is multifaceted, and the reaction of risks to the objective function are quite different and very varied and complex, far more so than would be the case in a corporate or the private sector. And for that reason, and the fact that you've got different decision-making processes, different governance arrangements, the concept of policy judgment, and all of those things go together to make it something that maybe is not quite as useful to try and pursue an exacting science, but it's more something that we would argue is good for polishing what we would describe as the black art of balance sheet management. Some of the useful features that we've found for government from taking a balance sheet approach to the way they look at things is gaining efficiencies in cash management and the structure of the budget. For example, in Australia, in the federal government, all of the cash management for the general government sector is managed by us, the debt manager. And that minimises the amount of funds that sit out there amongst the agencies and could be used in a less efficient way than having a centralised management of it. We certainly, I think, have taken the opportunity over a long period of time to help government, and I'm talking about executive government here, so ministers, better identify and understand the risks to the balance sheet and how new risks might be introduced. Although I separate that from saying the measurement, appetite and mitigation of those risks is often a different matter, and that's where we run into the the blockers of judgment and politics often. It's a very useful way to impose discipline on fiscal policy decisions, and I'll come back to this towards the end and explain how balance sheet approach fits under an umbrella or within a framework of a fiscal strategy that Australian governments are obliged to publish and meet. And it certainly helps to clarify different elements of the budget strategy and the fiscal strategy overall by heightening awareness of the fiscal aggregates. What are the challenges in using an ALM approach in government? Well, in some respects, there's decisions to be made as to who gets to shape what the balance sheet looks like and how those decisions are made. One of the things that we constantly are having a debate about in Australia with Treasury is whether or not we should introduce an ALCO for the Commonwealth level. And that debate inevitably leads to the question of whether that ALCO would be actually a decision-making body or whether that would be something that's in an advisory role. And there's all sorts of questions about, government ceding policy decisions to a non-elected body to do things when we might have the technical expertise to make advice on things, but we might not have, would not be seen as having the sufficient judgment to make those policy sorts of decisions. The other thing you'll find is that you often get conflicts between competing policy objectives when you are looking at the fiscal exposure, maybe to index welfare benefits on the other hand, and the fact that we've made a decision to re-enter the inflation index market back in 2009. Or if you are looking at the New Zealand example, they've taken balance sheet management even further than Australia has. And one of our subnational governments, New South Wales, has a fairly structured approach to this too. But one of the things that you find that you run up against in terms of challenges is how you might value some of the assets that government owns. For example, a forest which has got multi-use. How do you put a value on that, and how do you assess the risks around returns to those assets? Another thing I'd say is that if you're trying to manage the balance sheet and you're making decisions about things over a long period of time, the fact is that policy decisions or policy directions can change, and they do change appreciably, often with a change of government. And so this can effectively shorten the horizon for useful planning. Another question is, how is the risk appetite determined and expressed? Very often difficult to get decisions from government to express risks for appetite, and they typically would leave those sorts of decisions for people who don't want to be making them if they get it wrong, but yet nonetheless often reluctance from governments to express those things. And then there's decisions about who becomes the gatekeeper for introducing new risks to the balance sheet, who gets to make those policy decisions that allow new risks to be introduced. This is just a schematic of how the public sector balance sheet is constructed in Australia. So on the left there, you've got our public financial corporations. So they're created as separate entities and they're managed as such. They've all got their own boards and they're all making decisions about how to manage their individual balance sheets. And there you've got the Reserve Bank of Australia as one that sits outside of the general government sector and is managed independently. We have a sovereign wealth fund called the Future Fund, and then the Export Finance Corporation is another example. And they're all largely self-funded, but they do pay dividends. So there are financial flows between these three boxes, but the balance sheet covers the whole public sector. The middle box is the general government sector, and that's all of your normal servicing of government, so all of your agencies and departments. It includes the cash portfolio that I mentioned before. It includes the sovereign debt portfolio, and it also includes a range of dedicated funds that the government may have set up over time for different purposes. And then on the right-hand side, we've got public non-financial corporations, which once again exist under legislation, and they're typically service providers So Defence Housing, the Australian Postal Service, and Defence Procurement, and a couple of examples. They often would typically be seen as self-funded, but have the capacity to receive equity injections from the government, or at times maybe loans are appropriate, and they would also be expected to pay dividends back to the government. So, to what extent is it used in Australia? Well, as I said, it's not a highly structured and formal approach, but it's a very informed and aware overall in terms of the balance sheet and how risks should be managed. That's why in that second point there you can see that there's no central single manager of the government balance sheet, with the Sovereign Wealth Fund, the Future Fund being managed independently under a separate mandate, and the debt portfolio by us being managed by discussions with Treasury. Is this a problem? It hasn't seemed to be a problem to date. And when I say that there's no single manager of the government, there's certainly very close relationship between us as the Debt Management Office and the Treasury. We provide a lot of advice to Treasury on market-related issues and risks. And the Treasury obviously has a view on policy decisions that would impact the overall shape of the balance sheet. So our relationship with Treasury seems to complement quite well that sort of informal but effective single manager role. There's a legislated charter of budget honesty and a policy commitment by successive governments to have a AAA credit rating at the sovereign level. And these, to many extents, I would argue, are really good anchor points for fiscal and balance sheet discipline. The Charter of Budget Honesty requires that every Australian government